In this short recording, we're going to look at finishing the ratio or financial statement analysis section for week 7. So in the live webinar week 7, we introduced the whole area of investment ratios and we calculate a number of key investment ratios: earnings per share, price earnings ratio, dividend per share, and dividend cover. And as I showed you in a number of the companies that you can get and look at the Financial Times summary page, these are key metrics that are used by investors in the stock market. So it's important you can calculate them, number one, but also that you can interpret what they mean. Another key thing that you may come across when you're dealing with the investment section is this thing called the enterprise value. Now, when we talk about the equity value of a company, that's what we mean the market value of the shares in the company are. Right, so the market capitalization. So if you look at somewhere, for example, here, the likes of, we'll say, Ryanair, Financial Times, like we did in class, we can see here Ryanair's holding. It will tell me that the market capitalization of Ryanair, right, free float market cap is 17.27 billion. That's what we mean. That's the market value of the equity, the number of shares times the share price. Right? But there's another term that's also used in financial statement analysis called enterprise value. That's where you take the market value of the shares, the market cap, the market value of the debt, and you take off cash and investments. Right? So often we call this together net debt. So if you're looking at the enterprise value of the firm, that is your debt plus your equity less your cash. And the whole logic of that is it considers the whole idea. If you wanted to buy the company outright, you would have to buy the shares, you would have to pay off the debt, but you'd also get the cash. So it's the net of the cash. And that's often used to inform another ratio similar to price earnings ratio called EV over EBITDA. Now that isn't examined, but you might ever hear it. It's enterprise value divided by earnings before interest, tax, depreciation, amortization. So it is often used as a kind of takeover multiple that's used in corporate finance. So there are different variations. For calculation wise, you need to know the price earnings ratio, but just to be aware, if you come across this term enterprise value, it is the market value of the shares, otherwise known as market capitalization, plus net debt. Net debt is the market value of debt, less any cash and investments that the company has. So ratio analysis itself, look, it is very informative. It helps you to summarize the key information in financial statements, and it gives meaning to different figures. So you can put profitability relative to sales. You can look at your debt figure relative to your equity, right? So it helps you provide insight, and it does simplify the examination, right? Now that's not to say it's perfect. It is good at giving summary calculations, but it's important to be able to interpret them. And one big thing is your knowledge of the limitations. Because as we know from looking at Alexis, the in-class example, a ratio in isolation, it's very informative. Like, is 20% profit ratio good or bad? We don't know. What was it last year? What are our competitors at? What was the budget? Right? So it's only a tool to help you identify particular areas. And they are based on financial statements. So if you have poor financial statements, right, because of questionable depreciation policies, poor financial accounting, then you're going to have poor financial ratios. So it's important to say ratios ask questions, they don't answer them. And as we've seen with Alexis, they can easily be misinterpreted. Like when we looked at in week 7 with the PE ratio that went from 9 times to 82 times over a year, that could be easily misinterpreted. You need to understand what drives the ratio and how to avoid a misinterpretation. So they have a lot of benefits, but you need to be really aware that they are limited in what they can do. All right? To give you another example of that, the focused key thing is on isolation here. In most exam questions, you need to get context. That context can come in the form of a cross-section where you compare to competitors, you compare to industry averages, or you compare to internal budgets or internal targets. But the key thing here is it must compare like for like. Right? You must compare profitability ratios for companies in the same industry or efficiency ratios for companies in the same industry. If you don't, it's going to be meaningless because the efficiency ratios for a jewelry store completely different than a hardware store, completely different than a supermarket. And if you try and put them side by side, you're just going to end up misinterpreting it. It's not going to make sense and you're not going to get any value from that financial analysis. The other key thing is to look at context over time. So do a trend analysis. So I've given a little example here for if you were asked to comment on the revenue trend from 2013 to 2015. Well, if you said this was a construction company, this wouldn't be too bad because we were still coming out of recession in 2013 to 2015. You think they're probably doing quite well, right? They've maintained their revenue. Whereas if I told you this company was a high-tech startup for technology, then you'd be a bit more concerned to say, well, you'd expect a lot more growth in a company like that at that particular stage of their life cycle. So you have to be aware of the economic and industry conditions. If you're in a recession, or for example in COVID, you'll have a different perspective of what is good or bad financial performance than if you were on the crest of an economic boom, like of 2005, 2006, at that period of time. So context is hugely important here. The context of the industry, the context of the economic cycle, and the context of what industry you're in and how your competitors are getting on. If you ignore any of those, you're going to have very much misleading interpretation of what those ratios are. All right. So the general approach here, and the one that we have taken in looking at Alexis, the in-class example, is context the first thing. Who are you and what is your interest? So are you a bank looking to lend this company more money? Are you a shareholder looking to see if it's a good investment? Or are you a customer thinking about buying goods off this company? So every stakeholder will have a different perspective. So watching exam questions, you might be asked to take a particular perspective and comment then on your analysis from a shareholder's perspective, from a bank's perspective, from a supplier's perspective. First thing you always do, and like we did with the Alexis example, is the eyeball test. What I said is you look at the high level movements in the financial statements. Has revenue grown or declined? Is profit up or down? Have the assets increased? Where has the cash gone from? And has the debt increased? Where have the funding movements gone? And we've seen a lot of that to help you build a story with Alexis, where profitability declined, costs were growing quicker than revenue, cash was decimated, and debt was increasing. And before we ever calculated any ratio, we had all of that key information available to us to inform our story. Because that's what ratio analysis is. It's about telling a story. You're using the numbers to put some structure on them. Ratios help, but so do the financial statements and to know what to look for in each one of them. All right, so your practical uses for ratio analysis, they are very important in the real world. Whether you're valuing a business, whether you're looking at banks and they're trying to analyze a credit proposal, i.e. a loan application, to see should we give this business more money, or whether business managers are looking to see how this company is getting on and whether they need to tweak the strategy of the business. So practically, ratio or financial analysis is hugely important in the real world. And your key takeaway here is the ability to read and analyze financial performance of a business is crucial. If you're going to be a future accountant, you're going to be doing corporate finance modules, you need to be able to interpret what financial statements are telling you. Not just prepare them under IAS 1, not just know your debits and credits, but actually read and analyze them. What is this trend telling me year on year? And what ratio analysis allows you to do, as this thing shovel says, it allows you to dig deeper. So ratio analysis allows you to pinpoint the problem areas and ask the right questions. It is not going to give you the solutions. We don't know if the fall in profitability of our in-class example is a long-term trend or not, but it's asking us the questions. We know there's a problem with the overdraft. We know there's a problem with profitability and cost control, so we can investigate that further. And that's important to realize. That's what ratio analysis gives you. It gives you the power to investigate particular issues further. It doesn't solve those issues. That's where the manager comes in and your commercial awareness of what the issues are. All right. So in terms of follow-up work, there's two good chapters if you feel the need to follow up on this. Elliott and Elliott, chapter 28, and the Connolly textbook, chapter 35. They are available in the library through the scan and send service, but again, they're not compulsory. We have a question pack which is available on your loop page here. Question pack and solution pack 4 are up there. And I'm going to put up the detailed solutions to the Alexis question as well of the one that we went through in class. And there is going to be 2 tutorials, week 8 and week 9, focusing on this particular exam topic, financial statement analysis. All right. So this extra recording, a short one, finishes off the area for week 7 on financial statement, otherwise known as ratio analysis. All right, so make sure you go back over that. Go back over the Alexis example initially to make sure you're happy with the core calculations. Think about the summary study table that I talked about in the live webinar, where you summarize all the key ratios in 1 or 2 A4 pages to help you condense your notes and help you use them more efficiently then when you're going through questions. And then for week 8 and week 9, keep an eye out for the tutorials and try and practice them now in exam conditions without the reliance on the notes to see how you get on. And the solution and the recordings to those will be posted towards the middle of each of the weeks. All right, so that finishes off now this section on financial statement analysis.